Hello, everybody, and welcome. This is Tushar Chande. In the week ending August 16, 2024, the market has recovered from last week's sudden sell-off due to the yen carry trade unwind. So that gives us an opportunity to look at the brief history of market crashes and how we can trade them and exploit them. So let's dive in. A gentle reminder, past performance is not necessarily indicative of future results. So here's a brief history of market crashes. First, there's a sharp expansion in the VIX index, which is a measure of implied or expected volatility in the S&P 500 looking forward 30 days. It typically rises when prices fall. So VIX is rising, prices are falling. And at the end of the process, the market typically makes a V bottom or a H bottom. That is, a retest of the lows may or may not occur. So our problem is how to mark the start and the end of the volatility expansion period. We'll use my fully automatic moving average with settings of 10 and 10, that is fixed length of 10 days, a fixed offset of 5 days, and we'll use 100-day ATR bands of plus or minus 3 units. So mark the beginning of the process when the VIX index rises above the upper band, and we'll mark the end of the process when the VIX index retreats inside the band or falls below the lower band. So a bit of flexibility in how you want to define the end. This is daily data for the VIX index from 2010 May, when we had the first such incident of a sudden expansion in volatility, which led to the coining of the phrase flash crash. So observe that we're using FAMA with fixed 10-day length, 5-day offset, ATR bands of 3 units calculated over 100 days. The VIX rose outside the bands, retreated once, rose again, and then decisively came back inside the bands. This is another famous flash crash from August of 2015. Again, we see that we're using the standard FAMA 10-10-5-5 plus or minus 3 unit bands. The VIX rose very rapidly on a daily basis, made a high above 50, and then retreated fairly rapidly back into the bands. So a very rapid increase that lasted only a few days. So in this chart, we have the flash crash down below in 2015 and the S&P 500 in the upper panel. And you can mark the expansion in VIX with a rapid decline in prices. This is a 2018 crash where the Dow plunged about 1175 points, which was the worst decline in history up to that point. A very rapid crash in the market, and of course a very rapid increase in the VIX. So again, we can use our FAMA bands to mark the start and end of the process. And of course, we have a retracement of the prices as volatility declines. Here we have the 2020 COVID crash, VIX daily data. You see a very rapid and sustained increase in VIX that lasted for several days, eventually marked by a retracement back into the bands. I'm sure we're very familiar with this. Daily data for the S&P 500 in the upper panel, the COVID crash from the previous slide in the lower panel, and of course, a very sharp decline in prices coinciding with a massive expansion in volatility. Here we have VIX from the past couple of weeks, a sudden increase in volatility last week, and then a gradual decline as the market rebounded over the last 2 weeks. So for the next few slides, we'll look at price action rather than volatility action. This is a 2014 V bottom. Market sold off rapidly and then rebounded just as rapidly. And this is the Fibonacci retracement tool, but I've added an extra line at the 75% level. So we need to have a retracement above the 75% level to confirm the V bottom, which seems like a conservative measure, but seems to work pretty well. This is price action for the daily data for the S&P 500 index and the August 2015 flash crash. We have the retracement tool with the 75% retracement line. Note that we had a retest of the low before we rose above the 75% retracement. Observe the initial rebound got us to half of the retracement. Then we retested it, went back up to the 62% retracement before we retested the lows. This is price action from the 2018 decline. Again, a V bottom. The initial rebound was to the 38% retracement, slight pullback, market continues, and then rises above the 75% retracement before going on to make further highs. So the 75% retracement is a good reference level. This is a retracement of the COVID declines. Daily data for the S&P 500, we had a sharp decline, initial rebound to the 38% level, slight pullback, market continues, stalls at the 62% level before eventually rising above the 75% level. And after that, we had a fairly steady uptrend. So now that we've looked at the retracement, we can also use the TC blast indicator. This is the buy low with adaptive stop indicator. This is also fairly useful. This is the COVID declines. We had a very sharp sell-off and then rebound. The orange line is our entry trigger. The brown line is the exit trigger. So you would have entered fairly close to the lows in this general area and carried higher, maybe stopped out here, re-entered, stopped out there, re-entered, and then fairly close to the eventual high. So again, a fairly useful way to look at market lows. This is a longer term look at the TC blast indicator on daily data for the S&P 500. Most recently, we have risen above the orange line, so we are in the buy mode here. These were the lows last year after the summer sell-off. Again, we have gotten near the lows in October and then carried it with two steps. The early sell-off during the spring would also have given us a good entry point into the uptrend. So another way to deal with market volatility is to use the blast indicator. This is the state of play as of midday Friday on August 16th. You see the market the S&P 500 has retraced to the 75% level, which we have used before as a indicator that the decline may be over and uptrend could resume. So we have to keep an eye on that, but we have a lot of key events stacking up. We have many events on the calendar over the next few weeks. Jay Powell at Jackson Hole on August 25, and then NVIDIA earnings and PCE report the following week, the unemployment report at the start of September, and the FOMC meeting in mid-September, of course, with lots of geopolitical events in the background. So let's see whether the 75% retracement is a precursor to another pullback or continued uptrend. Thank you for listening, and I hope you will like and subscribe.